level of liquidity is really going to depend on how much house you're trying to buy, right? So the amount of mortgage payment you have to make, the amount of money you need to have on hand, that liquidity is going to depend on what you're looking to buy. But typically you want to be in a position where you've got yourself with at least 3 months of reserves and liquidity available. You want to get into the house and you want to have money available to buy the things that you want to buy, like furniture and things of that nature. And then you also want to make sure that you sock away for a rainy day, because things happen, right? No matter how thorough you are with the inspections and things that happen as you go through the buying process, things will still happen and occur. So you want to make sure from a liquidity standpoint, you have at least 3, potentially no more than maybe 6 months, 3 to 6 months of liquid reserves available. So when preparing and getting ready to buy a house, there's a couple of things that you need to be prepared for. There are more than just down payment involved with purchasing a house. One of the things that you need to be prepared for is understanding that you got to pay for an inspection. That's money you got to come out of pocket with up front. There's an appraisal. You've got to come out of pocket with that money up front. So you've got your down payment set aside, but now you got appraisal, you got inspections. You need to prepare for homeowners insurance. So you've got to shop for a homeowners insurance policy. While you don't come out of pocket with that, it is a part of closing costs, you do want to be in a position to where you know what that's going to be. So start shopping and looking for different quotes and estimates on homeowners insurance. Understanding that you're going to have to make sure that you are ready for your closing costs. Homeowners insurance is a great thing to be prepared for. When you're first time buying a home, you got to understand that there's typically going to be PMI, which is private mortgage insurance, and that's something that's a part of your monthly payment. Unless you've got enough money to come to the table and put down 20% or to buy that out, that's going to be a part of your monthly payment. So being prepared for PMI, homeowners insurance, understanding what property taxes are. Property taxes are something that you will pay in your monthly payment. So when you're out shopping for that lovely home, you have to understand that property taxes, if they're very expensive, you're going to be paying every month for that. And that can drive up your monthly payment costs quite a bit. So understand when you're shopping some of those components and factors. You got homeowners insurance, you've got an inspection out of pocket, you got an appraisal, you have PMI and property taxes. They make a big part of your monthly payment. Those are some factors to be considering as you look for your first home. So pre-approvals are something that your realtors will love you when you bring them a pre-approval letter. But most people don't really understand what it's based on. So I want to take just a minute to talk about what a pre-approval is based on. The first thing it's based on is credit. We got to check your credit to make sure that you're credit worthy, that your scores are sufficient for the loan type you're looking to do. The second thing is we got to make sure that you have a job and that you have an income source that can be used and approved from an underwriting standpoint as the government looks to insure that loan. The third thing that we look for is we look at your assets. How much money do you have? Do you have enough money for your down payment? Do you have enough money for reserves? Are you liquid enough to make sure that that reserve requirement can be met? So you've got job, you've got credit, and then you've got money, right? Those are the 3 things. So we look at those, we qualify you based on how much money you make once we know you've got the credit and you've got a job, and then we look to use about half of that to determine whether you can be pre-approved or not. Your pre-approval is based on a thorough analysis and review of your credit report, your job history, and your assets to make sure you have enough money. Once you have all of those that have been reviewed and approved, you now have a pre-approval letter. We take that information, we run it through an automated underwriting system. It comes back and tells us whether you're approved or not. Then we provide that information to your realtor so they know that you're now ready to shop and close on a home loan. First of all, from a first-time homebuyer standpoint, you can get into a home with as little as 3% down. You've got a conventional loan that can get you at 3%. You've got an FHA loan that can get you at 3.5%. And if you're in a certain place, if you're in a rural area, there's USDA loans, which are available for nothing down, right? It depends on the property and the area, and there's certain eligibility requirements, but you can get into a house with as low as nothing down. If you're a veteran, and we thank you if you are for your service to our country, but if you're a veteran and you're eligible for your VA benefits, you can also get into a home with nothing down. So there's a lot of 0 down payment options that are out there. Some of the programs that don't have any specific requirements are USDA and VA loans, right? But there's also grants and things of that nature that are out there. So talk to your banker, talk to your lender, talk to us at Fountain. We can help you figure out whether or not you're eligible for some of those 0 down payment programs. But if you're not, you can get into a home for as low as 3% as a conventional loan. You can get into a home as low as 3.5% for an FHA loan. So it is possible. It's not a lot of money, but remember, you just have to ask and find out. Don't assume, don't take anyone else's word for it, because things have changed in this industry over the last couple of years. The second thing that you need to understand where a fee could be hidden is in what's called a discount point. Discount points are typically what you pay if you want to try to drive your interest rate down a little bit. Sometimes when they quote you an interest rate, they will automatically load that with a point, right? A point is 1% of your loan amount. So understand a rate sometimes will cost you money to get that rate. So lenders and banks sometimes will hide fees in origination charges. Sometimes they'll hide it in discount points. And you as a first-time home buyer, you don't really know what all those numbers are. So you get it, you look at the bottom line, you don't realize that you got this great rate, but you're paying for it either in a discount point or through inflated loan origination charges or application fees. So those are two things that you can do from an apple-to-apple comparison, is you can ask lender one and lender two, what do you charge me to do the loan? Origination, application fee, underwriting fee, processing fee, you name it, same thing. Two, are there any discount points associated with this loan? So at Fennell Mortgage, we are very transparent. We tell you up front what our origination charges are. We don't charge you points unless you ask for points, so we're not going to hide a discount point for the rate. We are very transparent in terms of publishing our rates and our APRs, and it's important that you understand legally you must publish an APR if you discuss a rate or you market a rate. So if you go to fountainmortgage.com, if you go to our Facebook page, our Instagram, if you go to Twitter, you'll see our rates and you'll also see the column that says APR. So we are following the law from a compliance standpoint. So many may quote interest rates, but not many will quote APR. So it's very important that you understand that, because what is the difference between an APR and an interest rate? An interest rate is what your rate actually is. The APR shows you if you're being charged additional points, additional fees. So that difference between the interest rate and the APR truly shows you what the difference is in terms of what you're going to be charged. APR is simply the charges for the loan above and beyond what you're actually doing in closing costs, taken over the course of a 30-year fixed period. So if you were paying for all of those closing costs within your loan over 30 years, your APR is going to reflect that. So it's important because that difference will highlight any additional charges that you may be charged for, whether you know it or not.